So let's start off. Basics of a safe harbor 401k plan. Okay. The purpose of a safe harbor 401k plan is to permit highly compensated employees to contribute the maximum salary deferral permitted under law without subjecting the plan to what is called an ADP test. That compares the salary deferral rates of highly compensated employees to non-highly compensated employees. And there is only a permitted disparity that is allowed by law. And if that disparity is too great, meaning that the highly compensated group has deferred more of their income than the non-highly compensated employee group, then the highly compensated employee group typically has to take back a portion of their contributions with earnings, or the employer would be forced to make a contribution for the non-highly compensated employee group. Okay, so putting in an ADP safe harbor provision eliminates the need for that test, and it allows the highly compensated employees to maximize their salary deferrals. All right. So we're going to go over, there's 5 safe harbor plan designs that we're going to discuss. Okay. I've just outlined them here. There's a 3% non-elective, and this is given to all employees whether they make a salary deferral or not. Okay. There's a basic match, and a match, anytime you have a matching contribution, this requires the employee to make a contribution. Okay. Under a basic match scenario, the deferral is matched dollar for dollar up to 3%, and it's 50 cents on the dollar up to the next 2%. So if an employee is deferring 5%, the maximum match they will get is 4%. You can also do an enhanced match where it's dollar for dollar up to 4% of pay, or you could do dollar for dollar up to 6% of pay. Okay, you'll notice under the 4%, you get the same result as you would under the basic match. Okay, the only difference is the gap here between 4 and 5%. All right, there's a QACA match. This is a qualified automatic contribution arrangement. Okay, and here you can put in a basic match, which is less than the basic match over here. Okay, but you also can do an enhanced match, which is the same as right here. All right, and the last is called a 3-tier match. Some of you may have heard this as a stacked match. Okay, and that's where you put in a basic match here or an enhanced match here to satisfy the ADP safe harbor. You put in a discretionary match to satisfy the ACP safe harbor, and then you can put in a fixed match on top of that. And all of these qualify as safe harbor. All right. So let's talk about the 3% non-elective. So you must provide all non-highly compensated employee participants during the plan year the 3% contribution. It doesn't matter whether or not they've made a salary deferral. It doesn't matter whether or not they've satisfied an hours of service requirement, if that's in the plan document, or if they've been employed on the last day. If they are employed on the first day of the plan year and they are a participant in the plan, they will get a 3% contribution. That is 3% of their total compensation. Okay. You may provide this to highly compensated employees. It's not required. Some documents do, some documents don't. The advantage to not giving it to highly compensated employees is if you have a lean year where you are not able to make an employer contribution, or as much as an employer contribution as you would like, you're not going to be forced to give away money to highly compensated employees. Okay, you have to put away for non-highly compensated employees, but you're not going to be forced to put away for the highly compensated employees. All right. Again, it's based on the participant's plan compensation for the plan year. If your plan defines compensation as compensation from the date of entry, the 3% can also be based on that. We call that post-entry compensation. Okay. If the only contributions made to this type of plan is the 3% non-elective and the salary deferrals, okay, then we say this plan is exempt from a top-heavy contribution requirement. And again, it's provided that no other type of contributions are made to the plan. Also, the eligibility for deferrals may not be more liberal than that for the safe harbor contribution, okay? So let me back up for a second, what we mean by top-heavy. A top-heavy plan is a plan in which more than 60% of the assets are for the benefit of key employees. Key employees are owners and officers, okay? If a key employee makes a contribution in the form of a salary deferral or receives a contribution in the form of an employer contribution, and the plan is top-heavy, then a top-heavy contribution must be provided to all non-key employees, okay? But again, in this case, if the 3% non-elective and the salary deferrals are the only contributions made to the plan, we don't have to worry about satisfying a top-heavy contribution requirement. But what's important here is the eligibility for salary deferrals may not be more liberal than the safe harbor contribution. I've given an example here. If the eligibility requirements to make salary deferrals are 6 months and age 21 and entries on the first day of the month, the eligibility to receive the safe harbor contribution is 1 year of service, age 21, and entry is on the first day of the month and the first day of the 7th month of the plan year, and the plan is top heavy. What's going on here is you're bringing in employees into the plan at 6 months, age 21 on the first of the month. You're bringing them earlier than you normally would under age 21 and 1. Once someone becomes a participant in the plan and the plan is top heavy, they must receive a top heavy contribution. Okay. So you want to be careful of this. Okay. Safe harbor contributions are always fully and immediately vested. There is no vesting schedule tied to them. Once they are contributed to the plan for the employee, they are fully vested. So once the employee, once there's a distributable event, the employee is allowed to take 100% of that account balance with the earnings, okay? This type of contribution, the 3% non-elective, and let me tell you what non-elective means. Non-elective means that the employee does not get to elect the contribution. It is put on their behalf by the employer. That's why we call it a non-elective, okay? It's best suited for top-heavy plans with what we call a new comparability allocation method for profit-sharing contributions, which we're not going to get into. But this 3% contribution is included in the overall profit-sharing contribution for this plan. So it makes it ideally suited for this type of plan, okay? So if you have this type of plan, you'll understand why we have this 3% that we're using with your new comparability allocation method. Okay. The next safe harbor match is what we call the basic match. Okay. Your basic match is 100% of salary deferrals up to the first 3% of plan compensation, then 50% of salary deferrals up to the next 2% of plan compensation. And as I said earlier, if a participant is deferring 5%, the maximum matching contribution they will get is 4%. Okay, it's between 3 and 5% that 50% of the next 2% comes in. Okay. This match is provided to all participants with a salary deferral during the year. And again, you can't impose a last day or hours of service requirement. If they made a deferral, they're going to get the match. Okay. Again, it may be based on a participant's planned compensation for the plan year, the payroll period, the plan year quarter, calendar month, or any other period. Okay, that is defined in the plan document. Okay, and this is the value of your third-party administrator. Okay, is they will be able to explain to you what the best plan design is in order to meet your objectives. All right. Now, in some cases, a true-up contribution may be required, and I'll explain why that is, okay? Here we have two employees. We have plan year compensation, we have plan entry date, and this is their compensation from their entry date. So they're entering July 1st. So I simply just took 50% of their full plan year comp, okay? And I gave them two different salary deferral starting dates, July 1st and October 1st, okay? And this is their payroll compensation that they're going to be deferring on, okay? Now, if you notice here, once they start deferring off their payroll compensation, they get a total match of 4%, okay? But if you take this matching contribution here as a percentage of their post-entry compensation, This person is at 4% because, again, their post-entry compensation is the same as their payroll compensation. But this person didn't start until October 1st. So their match is only for the last quarter. So as a percentage of their post-entry compensation, it's only 2%. Now, if you take their matching contribution as a percentage of their full plan year compensation, which is over here, it drops down even further, okay? When we look at their full year deferral rate, we're taking their entire salary deferral divided by their compensation. We've got a deferral rate here of 5%. We've got a deferral rate here of 2.5%, okay? If the plan document defines the compensation to be used for the matching contribution as the plan year compensation, but you as an employer are depositing the matching contribution throughout the year, then you may have to make what we call an additional true-up matching contribution, because the matching contribution is calculated based on plan year compensation or post-entry compensation, not compensation for each payroll period. So under this scenario, this person would need an additional match of $1,240. This person would need an additional match of $2,340. And that gets them the 4% of their plan year compensation. Okay, so this is where, again, your TPA comes in. You want to talk to your retirement plan consultant, and you want to be crystal clear as to what definition of compensation is being used to compute the matching contribution. Okay, there's absolutely nothing wrong with making a true-up contribution at the end of the year if that's what you want. But if you don't want a true-up contribution, then you need to make sure that you're calculating the matching contribution based on payroll period compensation. Okay, so if this is something you want to talk to your retirement plan consultant about. Okay, and again, this plan, the top heavy, it's exempt from top heavy minimum contribution requirement because the basic match and the deferral are the only contributions being made to the plan. And again, safe harbor contributions are always fully and immediately vested. The enhanced match is simply the basic match, but we've just simply increased the formula. Instead of doing 100% of deferrals on the first 3% plus 50% on the next 2%, we're simply going to give people 100% up to the first 4%. Okay, or you could also give them 100% up to the first 6% of plan compensation. We just call this an enhanced match. Okay, again, it's provided to all participants with a salary deferral during the plan year. You may not impose a last day or hours of service requirement. Just like the basic match and the 3% safe harbor non-elective, it can be based on a participant's plan compensation or partial compensation. Again, this is defined in the plan document. Just like I just discussed, a true-up contribution may be required if the safe harbor match is deposited on a more frequent basis than the periodic compensation to calculate the match. Again, if the compensation used to calculate the match, as defined in the plan document, is plan year compensation, and you're making the contribution throughout the year, you're going to have to figure out if they need a true-up contribution. Okay? And again, this is exempt from top heavy, just like all the others, and it's fully and immediately vested. The QACA Match. The QACA Match requires what we call automatic enrollment of participants. There's two types of enrollment. A participant may come to you and say, I wish to enroll in the plan at 5% of my salary. That's what I want to contribute to the plan. That's called an affirmative election. An automatic enrollment is called a negative election. Participants are automatically enrolled in the plan at a prescribed deferral rate. They would have to submit an affirmative election to negate that negative election. Okay? So an affirmative election also includes a salary deferral rate of 0. So if someone doesn't want to make a salary deferral, they still need to provide you as the plan sponsor a salary deferral reduction agreement, an election form that states 0%. Okay. For a QACA, qualified automatic contribution arrangement, the default deferral percentage cannot be less than 3% for the first 2 years of participation. The third year, it goes to 4%. During the fourth year, it goes to 5%, and then it's 6% every year thereafter. Okay. This escalation of deferrals isn't required if your default percentage begins at 6%. So if you're going to begin at 3% or 4% or 5%, you need to escalate. If you're going to start at 6%, you do not need this escalation feature. The maximum the default deferral percentage may not exceed 10%. So you can start at 10% if you want to, okay? The big issue with a qualified automatic contribution arrangement is who's going to track the escalation of salary deferrals, okay? This is best left to automation, but if you don't have those kind of tools available to you, someone's going to have to track this. Either your payroll company, if you're doing payroll in-house, you're going to have to track it. Some TPAs may do this, some may not. You'd want to talk to your retirement plan consultant to determine that that's something we can do for you. I'm not sure if that is part of our 316 fiduciary services. I can certainly check on that and get back to you. That is one thing I did not, that's one thing I was not able to check on before presenting this morning. So I can get back to you on that, okay? As an alternative, the employer may make a 3% non-elective contribution instead of the matching contribution. It's the same 3% non-elective contribution that we discussed earlier, okay? They can also make an enhanced matching contribution that must be at least as much as the basic match at each tier. Again, this goes back to the enhanced matching contribution of 4 or 6%, okay? Salary deferrals may not exceed 6% of planned compensation. Now, unlike the other safe harbor methods, the 3% non-elective, the basic match, and the enhanced match, the QACA match you may subject to a vesting schedule. So you make, it's called a 2-year cliff schedule, meaning it goes from 0% to 100% at 2 years of vesting service, okay? It's the only safe harbor that has a vesting schedule attached to it, okay? The plan sponsor may also permit participants to withdraw their contributions between 30 and 90 days from the dates the salary deferrals were withheld from compensation. So if you automatically withheld salary deferrals from an employee's pay, they can come to you within 30 and 90 days of that withholding and say to you, I want those deferrals back, okay? At which point they would have to, enter into an affirmative deferral election to tell you that they don't want any deferrals withheld, or they could withhold them at a rate less than the default deferral rate that you've put into your plan document, okay? And again, this plan is exempt from top-heavy contribution requirements, all right? Okay, then there's the tiered match. Under the 3-tier match method, there's a first match which we call satisfies the ADP safe harbor, okay? The match may not exceed 6% of planned compensation. Deferrals that exceed 6% of planned compensation. You could do a basic match. You could do an enhanced match of 4 or 6%. So I've done the calculations for you here. This is based on 2021 limits. The 2022 limits just came out, but they came out after I had completed this presentation. So under each of these scenarios, you would see what the matching contribution would be: 11,600 under both of these, 17,400 under this, okay? The second tier satisfies what we call the ACP safe harbor. You may not match deferrals in excess of 6% of planned compensation, and you cannot exceed 4% of planned compensation. So what this ends up working out to is they get a 66.67% of match on 6% of deferrals, which is capped at $290,000 of planned compensation. This is the maximum compensation we can consider for planned purposes for 2021, That ends up being a match of $11,600. Oops. Okay, then we go down to the third tier, which is a fixed match. Okay, and again, this match may not exceed 6% of planned compensation. How much of this you have to calculate? So 58,000 is the maximum. We call this the annual additions limit. This is the maximum amount of money that a participant may receive in a plan year. Okay, we're going to subtract off the deferrals of 19,500. Okay, that's the 2021 salary deferral limit. Okay, we're going to subtract off the first match of 11,000. Oops, I shouldn't be clicking as I'm pointing. We're going to subtract off 11,600 from the first match up here. And we're going to subtract off 11,600 as the second tier match. And this is the remaining match they're allowed to put away, 15,300. As a percentage of compensation, it's 5.28%. That's simply 15,300 divided by $290,000, okay? But what we really need to do is we need to calculate what this is as a percentage of salary deferrals up to 6% of planned compensation. And this is the calculation right here. We simply take the match divided by our compensation times 6%. It works out to 87.93. Okay. The same under the enhanced match. Under the 6% enhanced match, it's a little bit less, 54.6, because they're getting a greater match up here. So they're going to be getting, so they're getting less match here, okay? The reason you need to calculate this fixed max percentage is because this needs to be in the plan document, okay? Under the fixed matched section of your plan document. This has to be in there, okay? Now, every year as limits change, as these limits change, the 290,000 and the salary deferral, you need to calculate what the fixed match percentage is going to be for that year, and you need to amend your plan document before the end of the year. So if you have a fixed match in your plan document, please make sure you talk to your retirement plan consultant to make sure that the percentage in your plan document is the percentage you want to be using for 2022. Okay. And again, it has to be amended before the beginning of the next plan year. Okay, let's go through the plan document and notice requirements real quick. All of these have to be specified in the plan document. Okay, for the 3% non-elective, there's actually two different notice methods you can use. You can use a one-time notice method, or you can use what we call a supplemental safe harbor notice method, under which the single notice method, one notice is given 30 to 90 days before the beginning of the plan year. Those are for your existing plan participants. For new participants, you have to give it no earlier than 90 days and no later than the date the employee satisfies the eligibility requirements. So as you have employees satisfy the eligibility requirements during the plan year, you need to make sure that they're getting a copy of the safe harbor notice, okay? If you're using the supplemental notice method, which we call the two notice method, one notice is sent before the beginning of the plan year, just like it is up here. But then a second notice is provided no later than 30 days before the end of the plan year, in which you commit to the safe harbor provision. If you do not provide this notice, then under most circumstances, your plan will not have a safe harbor provision for that plan year, okay? Under the basic or enhanced match, there's only one notice method. It's a single notice method. It has to be given again 30 to 90 days before the beginning of the plan year, okay? The basic or enhanced QACA match, again, the notice has to be given 30 to 90 days before the beginning of the plan year. What also has to be stated is the automatic deferral percentage. This is the default deferral percentage, and whether there's going to be an automatic increase, that also has to be in the notice. Also in the notice has to be whether or not you as the plan sponsor are going to permit withdrawals of those default deferrals. Okay, that also has to be in the notice. Okay. Under the three-tiered match, it's the same thing. You have to give a notice 30 to 90 days ahead of the plan year for the ADP safe harbor notice, okay? The ACP safe harbor notice doesn't necessarily have to be specified as an ACP safe harbor match in your plan document, provided it meets the requirements of an ACP safe harbor match, meaning it can be stated as a discretionary match. It doesn't have to necessarily be stated as an ACP safe harbor match in your plan document. And again, your retirement plan consultant can take you through this, okay? So that is safe harbor contributions in a nutshell, okay? Are there any questions that I can take from the audience? Do I not see any hands? Do not see any. I'm not hearing anyone. Can you all hear me? Hello?
Chris, we can hear you just fine.
Oh, Tom, okay, there you are. Okay, okay. I didn't hear any feedback. I wasn't sure if I was still live or not. So and here's one question and answer. Oh, I can hear me. Okay, so everyone agree. Do I have any questions from anyone in the audience about the basics of safe harbor provisions?
Chris, this Elke, it does look like we do have one question.
Okay.
Somebody entered in chat.
Oh, okay.
Will Definity provide plan sponsors with the notice requirement when it's due?
That depends. We can do it. We can most certainly do it, or we can work with your vendor. If your assets are with a vendor such as American Funds or John Hancock or Transamerica, Voya, they also have the ability to provide a safe harbor notice to you. So you'll have to work with your retirement plan consultant to determine which is best, whether we provide it to you or whether the vendor provides it to you. There are plus and minuses to both methods, and that's something your retirement plan consultant can work with you on.
Thank you. It looks like we do have one other question, and I'll note that there are a few of you who've raised your hand. If you do have a question, go ahead and enter your question in the Q&A panel. There we go. So, Tom, we may have some additional questions here. This is a big topic. One of the questions that came in chat was, can the hourly requirement be removed from a safe harbor plan?
There is no hourly requirement. Are you well, there is no hourly requirement for a safe harbor contribution. You cannot, that's not permitted. If you're talking about an hourly requirement attached to a discretionary contribution, you certainly can remove that. You do not have to have an hours of service requirement. That's discretionary.
Great, thank you. And there's a question about what's available after the presentation. So all of these sessions will be recorded. Yeah. And after those have been edited, then they will be added to the event webpage where you went today to join the session. So you'll be able to see the replays there. If you have further questions about your plan, best course of action is to reach out to your RPC. I'm sorry, it does look like we've got two more questions. What about this question. So what about the new law about part-time workers only needing to meet 500 hours of eligibility? And before you answer that, let me share that Brooke Cozart, who is our ERISA attorney, will be on later in the week to talk specifically about that question. So she's going to spend a lot of time about part-time, long-time part-time people.
Yeah. Right, correct. Yeah. That in itself is an entire presentation. Yeah.
So many of the questions are about that. So I would say if you have a question about long-term part-time employees, then I would say be sure to sign up or attend on Brooke's presentation day when she'll be talking about that. And I'm just going to double check and make sure that is in fact going to be, yes, that will be on Friday of this week. So she will talk specifically about that. So all of those questions about part-time long-term part-time employees, I would say sign up again to the presentation on Friday, and Brooke will answer all of those questions and more. With that, I think that's going to take care of it for right now. So Tom, I'll pass it back to you.
Okay, well, thank you, Chris. A great presentation. And also I want to thank Kim Patty and Julie Goodwin for their presentations earlier today. I hope that was useful to all of you. Really appreciate the interest. We have close to 200 participants on today's call, so they seem to have struck some interest. And as Elke just said, there are a number of interesting stuff coming up. Chris had briefly mentioned 316 services. Tomorrow is 316 day, so there's a lot of programming. Check your schedule, but same time, same place. And then later this week, all sorts of other interesting topics. So thanks again for your interest, and we look forward to seeing all of you tomorrow and through the week. Thank you very much.